can you deduct the premium payments with a whole life insurance policy? We get this question quite a bit. We usually hear it like this. I love what I can do with whole life insurance. I love the fact that the cash value grows without any risk. I love the fact that I can access the cash value like a personal line of credit. And I absolutely love the fact that I can access it tax-free. What I'm thinking about doing, Steve, is running this huge premium payment through my business. The business can own the policy. This way, it's an expense, and I can deduct the full premium payment and at the same time, access the cash value. I can do that, right? The answer is, unfortunately, no. We cannot do that. If someone doesn't own a business, we'll hear, I love the cash value in a whole life insurance policy because of the safety, liquidity, tax-free, all that fun stuff, and I can deduct the premium payments just like I could with a 401k, correct? The answer also is, unfortunately, no. We cannot do that. However, there are accounts available that allow us to deduct very large premium payments. We can put a life insurance policy into a qualified account. We'll talk about that a little bit in today's video, but there are also some pros and cons to that. So what we'll do today is raise questions that people ask about whole life insurance and deducting the premium payments. And we'll also talk about the different types of accounts that are available to individuals that allow you to take tax deductions versus those that do not allow you to take tax deductions. And we'll talk about the pros and cons. We'll go through how individuals often approach these. So let's begin with the question we have up top, which is, can I deduct my premium payments? The answer to the question is no. This applies to premium payments and also PUA payments. Your PUA, that paid up additions rider, that's how we maximize the cash value with a whole life insurance policy. Now, what if you own a business, or if you set up a policy where it is owned by your company? Can you expense the premium payments like you could with other insurance policies? The answer is no, that is not possible. When we look at a cash value life insurance policy, it is considered a non-qualified asset. If we wanted to be able to take tax deductions, we would need a qualified asset. Now, if those terms are foreign to you, or maybe you've heard of them, but you're not familiar with them, we're going to talk about these two, and we're going to blend in cash value life insurance when we discuss these as well, because we do get this question sometimes, what does that mean? Or maybe someone's afraid to ask because they don't want to sound foolish or anything like that. I felt like that before. So let's start with qualified assets, and I'll give you an example that most people are familiar with. A great example of a qualified asset is a 401k. A 401k allows you to capture tax savings up front. However, when you eventually take money from that 401k, you are going to pay taxes. So a 401k results in tax savings up front, and you'll pay taxes later. When we look at a 401k, usually the purpose of this account is to save money for retirement, and when we access it, in most cases, it is going to be after age 59 and a half. If I want to access it before age 59 and a half, I do have a potential 10% penalty tax for early access. Now, there are some ways you can get to some money in a 401k, but that account is designed primarily for retirement. And that's the case with most qualified assets. So, with a qualified account, what you will see is that money that you add to that account is typically tax deductible. What that means is you're funding it with pre-tax money. It's money you have not paid any taxes on. Let's go through an example of this. We'll pretend that you make $100,000 per year. You add $10,000 to a qualified account. Pretend it's a 401k. Because it is a qualified account, that $10,000 payment is deducted from your income. So you earned $100,000 and you got to deduct $10,000. Now, does this mean that you'll save $10,000 in taxes? Because I think this is assumed sometimes. First time I heard this, I'm like, wait a minute, I'm going to save 10 grand in taxes if I put 10 grand into a 401k? The answer is no, unfortunately, not quite. So here's how it works. Let's demonstrate this with what your situation would look like before you put money into a 401k, and then after you put money into a 401k. And we'll use the exact scenario we just looked at. You make $100,000 per year, and you're going to add $10,000 to your 401k. Ready? Let's look at before. Your income, $100,000 per year. We'll just assume your tax rate is 25%, which means you're going to pay $25,000 in income tax. How about after the 401k? You contribute that $10,000, your taxable income comes down to $90,000. So the $10,000 contribution you make is deducted from your ordinary income. So now your taxable income for the year is 90 grand, not $100,000. Assuming you have the same tax rate in this example at 25%, the taxes that would be paid would be $22,500, which would result in you saving $2,500 in tax, which is still pretty nice. It could be a little bit more. The 401k might make my effective tax rate a little bit less too, which could even bump up the savings a bit more. This is definitely where I would talk to an accountant or CPA and make sure we plan properly. But when we look at qualified accounts, they allow us, again, to save taxes up front. That's the big advantage there. So tax savings is all up front, but I will pay taxes later when I eventually go after that money. Let's compare that with a non-qualified asset. And I'm going to focus this specifically on life insurance here. We do not get tax savings up front. However, we don't have to deal with taxes later, assuming we don't mess the policy up, because it is possible to run into a taxable event, but it's easy to prevent too. So with a whole life insurance policy, you can access your cash value anytime you'd like, and you can do so without taxes, provided we do so with a loan. And remember, you do not always have to pay loans back either. So it depends what your goals are. A lot of times people do want to repay loans when they see how they work, but what I want to hit on here is we can access the cash value anytime. We can get to it tax-free as well through loans, and there's no penalties when you access the cash value. So you can access the money much earlier than what you could do with the 401k. So you've got a bit more freedom to accessing your capital there, which a lot of people are attracted to, which is nice. The main point is that the money you add is not tax deductible. So money that you add is considered after-tax money, unlike a 401k or qualified account where you're funding it with pre-tax money. So let's look at the same example. You make 100 grand per year and you add $10,000 to your whole life insurance policy. A non-qualified asset means there will be no tax deduction. The tax savings up front will be zero, and this is very similar to a Roth account. You might be more familiar with a Roth 401k or Roth IRA. Let's look at an example here, and we'll go back to whole life insurance. So we'll look at before you put money into a whole life insurance policy, and then after you put money into a whole life insurance policy. We'll use the same $10,000 that you're adding to the policy here. So beforehand, if your income is $100,000 per year, your tax rate is 25%, that means you'll pay $25,000. After you add money to your whole life insurance policy, your income is still $100,000. That $10,000 deposit did not allow you to write off anything. You're still at the same income here. So the tax rate will not change, 25%, and the taxes paid up front are exactly the same. I paid $25,000 and my tax savings is zero. Now the important item to note here is that this is all up front. Remember, with the life insurance policy, when I access that cash value, I don't have to pay taxes on it. What a lot of people do here is use cash value life insurance to take income in retirement on a tax-free basis. They're taking loans and even withdrawals, so they're withdrawing money, which does not accrue any loan interest, and they're also taking loans without paying any loan interest. It's a method you can use to take income from a life insurance policy on a tax-free basis. So someone that takes that approach will typically say, okay, I'm fine not saving on taxes right now because I know it's going to benefit me later, especially if tax brackets are higher or if I have less tax deductions. Now I don't have to worry about that as much. Typically, what we see very successful people do is a little bit of both. A lot of people we work with have both, and they've got their money in other places too. So I am a fan of both. It's really just knowing how they work and then planning properly or having someone talk through the different options. Writing things down is one of the best things you can do. Now, what if you said, well, I really like life insurance, but man, I want that tax deduction. What I'm going to hit on next mainly applies to business owners. There is what is called a 412 or a 419 plan available. And what this entails is putting life insurance policies and annuity contracts into this plan. Now, this plan is a qualified plan. So a qualified plan would be something like a 401k. The difference is when you look at the contribution limits with these plans, they're quite large. So you'll see a lot of small business owners set these plans up where they want to contribute $50,000 or $100,000 or perhaps several $100,000 per year into these accounts. So it generates large tax deductions upfront. There are some things I do have to commit to from a planning standpoint, but some people are attracted to this, and typically this is purchased because of the guarantees. When I look at life insurance contracts and annuity contracts, what do I always see? Guarantees in there. So someone who is very attracted to the guarantees, they don't want to take on risk, they want the tax deductions up front, that's more attractive to them right now, that's where it could be a fit. The drawback to that is lack of access to the cash value, because again, it's a qualified asset. So anyone that is attracted to cash value life insurance, because they want to be able to access the cash value during their working years or use it for their business, if you've got it tied up in a qualified account, you are going to give a lot of that up. So that's one of the things we definitely want to make sure we talk about and fully understand before we start any strategy. So in experience, here's what we see most people do. Most people that we work with decide not to take the upfront tax break. Meaning, if they're going to put money in a whole life insurance policy, they're not setting it up in a 412 or 419 plan. Or they're not setting it up where the life insurance policy is held within a 401k. Did you know you could do that? You can actually have a life insurance policy placed inside of a 401k. We've seen people do that before, but typically people we work with do not like it because they don't have access to the cash value. What we see most people want to do here is they'd rather pay the taxes up front, just rip the Band-Aid off, get it done with, but then have access to the money whenever they want and not have to deal with taxes. Because remember, if you do everything right with a whole life insurance policy, it's very easy to access the cash value on a tax-free basis. So that's typically what we'll see most people do. So I do hope that this video was helpful. If you'd like to learn more about doing things right to make sure a taxable event does not happen with a whole life insurance policy, you can check out this video here. And as always, I hope this helps. Thanks so much.